Hello, everyone.
Good morning.
Okay. So first of all, any doubts on whatever we discussed in the last hour? Anybody else? We were discussing.
Ma'am, can you just explain the amortization charge on operating lease?
Okay. Sure. So, like I said, operating lease is something which is creating value for the business. So any kind of uh, depreciation. See, amortization is nothing but the depreciation that we have to deduct it from the profit after tax because we haven't done that. In PAT, we have already deducted operating lease because the companies consider the rentals paid for operating lease as an expenditure, isn't it? So we have already deducted that. But as per EVA, what they say is you should not deduct it, you should capitalize it. So once you're capitalizing a particular item, wouldn't you also provide depreciation or amortization for that capitalized item?
Yes, ma'am.
Yes, we haven't done that here in the PAT, correct?
Yes, ma'am.
That's why we're deducting it.
Yes, ma'am. But ma'am, what does it mean amortization on operating lease? Like
It is
why?
depreciation.
But
It's a
the lease, so the lease would be for some asset. So wouldn't we just depreciate the asset?
yeah, it is the asset that we're talking about over here. Operating lease is for an asset. Amortization charge is for that asset. Amortization charge is nothing but it's like a depreciation only.
Okay, ma'am.
Yeah. Good. Good doubt. That was anybody else has a different doubt? Okay. So let's move on to capital employed. Capital employed, there are actually many adjustments in capital employed, but I think in P2 for your level in SEMA, right? You have three level, right? What are the three levels? Operational, management, and strategic level, if I'm not wrong. So I think in your management level, this is the only adjustment that they have given under capital employed. They just simply have told that you begin with the opening capital employed and you make adjustments for the net replacement cost of the tangible non-current assets, and that's it. But ideally, there are many adjustments. Some adjustments, what you have done here in the no path itself, will be reflected in the capital employed. But we're not getting there because that's not what is covered or it's not what is there in your P2 textbook. So I'm strictly sticking to what is given in your P2 textbook, okay? So it's very easy for you, capital employed. So just relax. Then obviously cost of capital should be given to you in the question. You just have to multiply it and deduct it with the NOPAT that you receive. The most important from exam perspective for all of you guys, please make a note that NOPAT is very important. Of course, they will ask you to calculate EVA, but there can be a question, and there is a question from your textbooks where they have asked you to calculate NOPAT. Okay, so please mark this calculation as very important. Now, before we get into a problem, I would like to discuss the advantages and the disadvantages of EVA. So, I've already written them down to save time. Some of the advantages is that it sorts of considers both the short-term as well as long-term value creation. I have already explained that before, and that's why it's one of the favorite tool to maximize the shareholders' wealth, and it's aligned to the organization objective. It does not really considers uh, accounting adjustments, right? That's why we add back accounting depreciation, we add back provisions, because they are all not the real cash outflows, and they are all based on accounting practices and policies. So therefore, it completely avoids any kind of distortion as a result of those. And one important benefit because of that is that it results in goal congruence. So otherwise, what happens is if you use accounting standards and principles, you have a lot of loopholes in the standards. We're aware about some of the loopholes, and the profits can be easily manipulated. Okay, but EVA just does not consider that. It's purely based on the real cash flows. There are many other advantages, but at least remember these three clearly. If you would like to know more advantages, if you want to read more about EVA, I can send you a few links, only if you're interested. Otherwise, I don't want you guys to overload yourself with too much of information. Okay, so those are the advantages. Disadvantages, calculation seems to be pretty complex, isn't it? And there are numerous adjustments that we have to learn. Actually speaking, as per the, what do we say, as per the committee who had developed EVA concept, and as per those professors who had developed the concepts, there were actually more than 100 plus adjustments. But for your academic purposes, only they have restricted for these many number of adjustments. So there are actually numerous adjustments to both the profits as well as capital employed. Plus, it's an absolute measure. You know, what do I mean by absolute measure? It is not in percentage, right? Whatever answer that I get using this particular formula is not in percentage. It is in a value. That's why we call this as an absolute measure. If it is in percentage, we call that as a relative measure. This is an absolute measure. That means it is in value, not in percentage. So because it is not in percentage, it does not facilitate comparison. Okay, let's take one more small example, a gross profit margin. How do we calculate this gross profit margin? Very simple. We take the GP, the gross profit, and divide them by sales and multiply that with 100, right? Now, what are we trying to do here? We're taking a relative measure of gross profit. So what is the gross profit relative to the sales, right? Now, if I calculate gross profit for company A and company B, both if they are of different sizes also, I can still compare it because I am comparing GP with the sales of the respective companies. Getting the point? But I can't do that with EVA. So it does not facilitate comparison between two different sized companies as it's an absolute measure. Everyone's clear with that point?
Yes, ma'am.
Okay, I believe everyone is clear. The third one is there are many assumptions when deciding on cost of capital. Actually, cost of capital, we have studied that it's an market interest rate, or in other words, it is also a weighted average cost of capital. So there are a lot of assumptions in when we consider those factors. Like, how did you arrive at the weighted average cost of capital? Have you guys studied weighted average cost of capital between?
Yes, ma'am.
Sorry, I didn't hear that.
Yes, ma'am. In the previous semester.
You have. You have, no? So how do you calculate this weighted average cost of capital? You have two things mainly, right? You have the cost of equity. Some of you might have forgotten. So just to recollect, cost of equity is there. And then you have the cost of debt. And then you have the weights, which is basically the value of equity and the value of debt will be taken as the weights. Like you take the proportion and try to calculate the weights. So there are so many assumptions when you arrive at the cost of equity, when you arrive at cost of debt, right? So that is one drawback, that cost of capital suffers from a lot of assumptions. If one of your assumption is is faulty, then definitely your EVA will be also faulty. It will not give you the correct picture of how much value has been created or destroyed by the company. That's a drawback. Plus, another important thing, this is like a common disadvantage for all sorts of financial KPIs, that all these financial KPIs are all based on historical data. Like it's all based on the past data, whereas the shareholders are more interested to know about how the company is going to perform in future. Okay, now this drawback can be eliminated if you introduce non-financial performance indicators. Non-financial performance indicators. That's why we are doing a project. That's why we have that question in the project that I was talking about yesterday. Okay, so advantages and disadvantages. I hope that you guys are clear with it. Let's do a question quickly. A company with several divisions have a cost of capital of 6%. An excerpt from division B's accounting summary for the period is shown below. Okay, so they've given us gross profit, net asset at net book value, bank loan, value of closing capital employed is given, total provision is given, replacement cost has been estimated at $700,000 if the assets have been revalued. At replacement cost, the depreciation charge would have been $70,000. So ignore taxation, calculate EVA. That's the question. So first of all, we need to begin with NOPAT. Correct? So what do we start when we have to calculate NOPAT?
Profit after tax, ma'am.
Okay. So profit after tax is how much?
1,70,000.
Good, 1,70,000. Then what do you add back? What all can you add back?
Accounting depreciation of 1 second, ma'am. 50,000.
Correct. So this depreciation that they've given here is the accounting depreciation. So we need to add that back because they've also given us the economic depreciation. So we will deduct that. So this is 50,000 to be added. Good. What else?
Provision for bad debts.
Yes, provision for doubtful debts. Correct. Provision, which is 25,000, isn't it? So I will write that 25,000. Good. What else?
There are no development costs, like there are no training and development costs or anything
Yeah,
like that.
nothing is there. Correct.
No advertising cost as well.
No advertisement cost.
So that's it, mom.
Look properly.
And replacement cost is also to be considered.
That will come for capital employed.
Oh,
Not studied any adjustment for replacement cost for no pat, right? Remember, I was talking about replacement cost. Where did I talk about it? Here.
yes, ma'am.
Okay. Come on. This part is there, no? In the question.
Interest net of tax.
Yeah.
5,000.
Correct. So we need to add that also. What is the value here? 5,000. They have asked us to ignore taxation, okay? That's why we are not going to make it net of tax. Did you guys see here? They are asking you to ignore taxation. So I'm just putting this in brackets, ignore tax. You can do this in your exam also. If you want to give a note, please feel free to give a note. The examiner or whoever is correcting your papers, then they will also have a clarity that what assumption you guys have taken. And on the basis of that, you have taken the calculations. You will still get full marks. Okay, but here it is not an assumption. It is actually you're strictly following what is told to you in the question. You've been asked to ignore taxation, you're doing that. Okay, had this particular wordings weren't there, you would have taken interest net of tax. So how would you take interest net of tax if that was the case? Just I'm calculating. How would you do that? Interest net of tax would have been 5,000 into 1 minus 6%. What is the tax rate here? Not given the tax rate only. Okay, great. So imagine tax rate is 30%. Okay. So 5,000 multiplied by 1 minus 30%. So 5,000 into 70%, which will be 3,500 if I'm not wrong. Is that correct?
Yes, ma'am.
Yeah. So this is how you'll have to do if they have asked you, I mean, if they have not told you anything regarding ignore taxation and they have given you the tax rate. So here both are not there. In the sense tax rate is not given and they've asked you to ignore taxation. So that's why you're not doing interest net of tax. So this is just a small illustration. Delete. Okay, so anything else to be added?
No, ma'am, that's it.
Okay. What to be deducted then?
Economic depreciation.
Economic depreciation, very good. So you have,
Oh,
what is the, sorry,
70,000.
depreciation. You have to deduct 70,000. Absolutely right.
Ma'am, so the way to figure out the difference between accounting and economic depreciation is the accounting depreciation will be given in the statement. Main
Exactly.
statement, right?
It will be given in your adjustment. These are all your adjustments.
Okay, ma'am.
They would have told you. Sometimes they directly tell you accounting depreciation is so much. Whatever is there in your profit and loss statement is the accounting depreciation. So this is your profit and loss statement. Correct, na? This much is your profit and loss statement. So this is what you see here is the accounting depreciation. That's how you figure out. Okay. So would you guys have any other adjustments to be added? Do you see anything else?
No, ma'am, there's no goodwill. There's nothing that's amortized or anything.
Correct. Nothing of that sort, right? So let's Calculate, can you guys tell me quickly? I don't have a calculator with me. Can you please tell me what is the NOPAT over here?
1,80,000.
1,80,000. Good. That's done. Now we have to do the capital employed. So capital employed we start with the opening capital employed. So here, what is the opening capital employed?
It's not given, no, ma'am.
Okay, see here they've told us the net assets at net book value is given, bank loan is given, value of closing capital is given, replacement cost is given. Okay, so they've not told you that this is the opening capital. But from these three values, like 500,000, 525,000, and 700,000. So just put 2 stars in 500,000 net assets at net book value. There are 2 stars put here, and that is for this, right? So this is a closing capital, 525. So what should this be? This will obviously be the opening one, isn't it?
How, ma'am?
See, they've already told you this is the value, closing capital employed is 525. There's one more value given to you. What should that be? If one is closing, the other one will be opening only, no?
Okay, ma'am.
Hmm?
Ma'am, but it says replacement cost, right? Like,
Yeah, so that's what I'm coming to. So when they've told you that this is the opening value, 500, they've also asked you, they've also put some star mark there and told you that there's a replacement cost which is estimated to be 700,000. Now, economic value added. Again, going back to its literal meaning. What does it mean? Economic value added only considers a real cash flows. Now, if you were to sell this net asset, what value would you fetch? You would fetch 700,000, right? That's the replacement cost. I hope everyone understands replacement cost. It's the value you would receive when you replace that asset or sell that asset in the market. So that's the market value.
okay, ma'am, got it.
Got it? So that is the value you would write here as instead of 5 lakh, you would not take 5 lakh. What would you take? 700,000. Anyone has any doubt in this?
Ma'am, shouldn't the opening capital employed be 5 lakhs only and then you add the replacement cost of 7 lakhs?
If you want to do like that, also you can do like that, but this is a better way of showing it, no? What will you show that 2 lakh as? You have to put some name to it. What will be the 2 lakh adjustment called? What will you say? Increase in the fair value?
Oh, yes, ma'am. I don't know.
Or revaluation surplus? What will you say?
Ma'am, I thought we should add that 7 lakhs as a replacement cost
To what?
to the opening of 5 lakhs.
Oh, no, no, no. It's not like that.
Oh.
As per the books, see, they have told you net book value. What does net book value mean? This is as per your books. In your accounting records, 500,000 is the opening value of that asset. But as per market, the value of their asset is 700,000. And we know that economic value added only considers real cash outflow or inflow. So if you were to sell their asset, you would not receive 500, you would rather receive $700,000. That's why you take $700,000. Make sense?
Yes, ma'am.
Yeah. So I have taken that. Any other doubts? Any clarifications still?
So is there anything else that we have to remember? Like replacement cost is like the opening capital employed, right? So is there anything else that we have to remember in the same way?
I am sorry, I didn't get you. Come again.
I'm like, for example, in this question, instead of opening capital employed, they have used the word like replacement cost, right? Like because it's adding back value. Like I understood the concept, but is there any other terminology like that we have to remember, like in
Yeah, they
this
would tell
case?
you market value, they would tell you fair value, all that is the same. Instead of
All that is opening capital employed, is it?
no, that's not what it's. It doesn't see opening capital. Matlab they'll tell you it is opening capital.
Okay.
How did I make out that this 500,000 is opening capital? Is because they clearly told. See here, value of closing capital is given to you as 525. Correct. That means there is one more capital. Net assets is nothing but your capital employed, na Baba. What is net assets? It is
It's
nothing but capital
capital.
employed. If you guys remember the formula of capital employed we had studied when we did ROCE calculation, return on capital employed. So capital employed there was uh, equity plus debt. That's one way of calculating. Another way is you take the total assets and minus it with the current liability. So you get net assets.
Okay, so basically, the all the assets that we have, the book value is estimated to be 5 lakhs. But like when you sell them off, the replacement cost that's the value that you would gain in the market would be 7 lakhs.
Correct.
So we'll consider 7 lakhs because that's the actual, that's something that's creating value and something that benefits your organization.
Exactly.
Okay.
Replacement cost is also called as fair value. They might say it as fair value or they might tell it as market value. It's all the same. Net assets is another name for capital employed. At net book value is the value recorded in your books. That's what these terms mean. Okay, so good doubt. Okay, so I hope with that everyone has got clear with what needs to be done and how you need to understand. Okay, we have one more adjustment in the capital employed, which is the total provision. So if you see here, there's one star mark put for your provision for bad and doubtful debts. As per your accounting records, the amount is 25,000, which we have added back because we don't consider them as the real cash outflows. That's why we added back. Now we take this total provision of actually the total provision is not 25, it is going up to $50,000. So this provision also is something which needs to be added to your capital employed. So add the provision, the total provision, which is of 50,000. to your capital employed. Okay, now why do you do that? So actually the definition of capital employed, when we see, as I explained earlier, it is the total assets minus current liabilities, or you can also calculate it by using total equity plus total debt. So when you use the first formula, right, total assets minus current liability, total provisions, where do they come? Where do we show provisions usually in the balance sheet? We show them under current liabilities.
Okay.
Is it not assets? It is current liabilities, right? So that is why, because it's already deducted there, we will have to add that back to increase our capital employed.
Okay, ma'am.
Okay, so then now my closing capital employed will be 750. Done. Now we simply have to use the formula of EVA. EVA is equal to, I'm not writing the formula. You guys can tell me formula if you want, or I put the key in the figures.
Closing capital employed into the expected rate of return or the capital employed, like
Cost.
the cost of capital. Sorry.
Yeah, cost of capital. So first you have to deduct that from Notepad. And then calculate this expected return, whatever you just said. So cost of capital is given to us at 6%.
45,000.
What is the value of 715 to 6%?
45,000.
Acha, 45. So now what is the answer?
1,35,000.
1,35,000. Okay, so that's my EVA. So you have an option there, 1,35,000. So your correct option is option C. So in your exams, you will not be getting this as a OTQ question. Most probably, I predict that you might be asked to solve and find out EVA. You won't be given options. Okay, that's the 80% of chances. 20%, you never know. You might have these small OTQs coming for you to select answers. Okay, but 80% chances you might have to work out a problem on EVA. So with this understanding, we had done a couple of problems. This also was a problem that we solved in the class. There are more problems, not too many, but one or two maybe. You can try them out with this understanding and see if you can crack them. I think I had given you homework also that time. Yeah. Objective type question number 3 in page number 317 is in chapter number 8 from your P2 textbook. Okay. That's only another question there. Plus, you also have revision kits with you guys, no? So let me just right away see if there are some questions from there. Practice kit. There's a question on page number 139. Sorry, not page number 139, page number 50. Question number 139. So P2 practice kit. Question number 132, page 50. Try that. And you have again another question. In question number 156 in page number 58. Okay, so there are these three questions, I think, should be sufficient for you to understand the concept a little more in detail. So try and do these three questions at least and check if you can do it on your own, whether you have understood the concept. Okay? So you could do this on your own. Next week, we will start revision on module number 3, and slowly then we will start with the revision in module number 4, as you guys requested yesterday. So for today, this is it. Any other doubts?
Ma'am, excuse me, ma'am.
Yeah.
Ma'am, regarding the CIA, ma'am,
Yeah.
how should we go about with the techniques of benchmark, ma'am, like for the company?
Techniques in the sense?
No, ma'am, you had told us about there are certain different techniques of benchmarking, like the internal.
Benchmark.
How should we go about that, ma'am? Because, like, I'm not understanding how to get get the information from the thing.
So, like for example, you know the different types of benchmarking.
Yes, ma'am. Internal, external, and
functional.
functional. Yes, ma'am.
So internal benchmarking, for example, now in Reliance Industries, they are into different segments.
Yes, ma'am.
Right, into petroleum, retail, agriculture. So if they benchmark the performance of Reliance agriculture with the Reliance retail, what will happen? I mean, will it give any advantage to the company? Or not?
Okay.
Okay. Then
Yes,
that
ma'am.
is, yeah. So internal benchmarking is not just comparing the financial performance. See, obviously, you can't compare how Reliance's agriculture sector is doing compared to Reliance's retail.
Industry. Yes, ma'am.
In the quantitative terms, financial terms, because
Yes,
both are two different sectors. So what I'm saying is try to benchmark some process or some kind of activity, like maybe recycling for that matter. Try to see how recycling is working well at agricultural sector compared to the retail sector.
Yes, ma'am.
Okay, that is one way. So that's about internal benchmarking. Similarly, you can have external benchmarking, for example, competitive benchmarking. So use the rivals of Reliance in, say, for example, petroleum industry with, like, let's say Shell, maybe, for example.
Yes, ma'am.
Okay, so that way. So what you could do is just give the different types, headings, give the explanation about it, and use Reliance as your company and find out which other companies or divisions can Reliance benchmark itself.
Yes, ma'am.
Got it?
Yes, ma'am.
Okay.
Thank you.
Okay, no problem. Any other doubts? Okay. So I will notes that we did today. Go through them and go through the recordings again if you have any doubts. And if you still face any issue, you can get back to me again. So we'll end it here. Thank you so much. Bye-bye.
Thank you, ma'am.
Thank you, ma'am.
Thank you, ma'am.